Let's talk about something called depreciation and go through a few definitions first, and then we'll work on a problem. First of all, we're talking about assets, fixed assets, long-term assets, assets that we think will be used in the business to help us make money that will last longer than a year. The matching principle says that we have to evenly allocate the cost of these assets over their estimated useful life. This is an inventory. This is fixed assets, a building, a truck, a forklift, a computer, machinery, furniture. Has nothing to do with value. We're going to be talking in this video about the methods called straight line depreciation and production. So these are the two methods that we'll be using. And again, taking a long-term asset and matching the cost of this asset as an expense evenly and periodically to match it with the revenue it helps to make. So for example, a trucking company can make no revenue if it doesn't have trucks. A truck lasts longer than 1 year. So let's look at this example for a truck. This truck is purchased for $50,000. That's the asset's cost. We take this $50,000 first and we subtract out the estimated residual value of $10,000. Residual is also known as salvage value or scrap. So we have a depreciable cost of $40,000. So cost less residual value equal to $40,000 for depreciable cost. We take this $40,000 and we divide it by the 5 years that we anticipate this truck to last. Remember, this is an estimate. That's the most important concept. If we do so, it's $8,000 a year. So very simply, under the straight line method, depreciation the first year and every single year is $8,000. If we wanted to divide this by months, that would be taking this and dividing it by 12, and we would find that that is equal to around $667 per month, and so we could very easily do this in that way. So that's method one. Let's go to the second method, and this one is called the production method or the units of activity method. So we take this exact same information, the $40,000 depreciable cost. Remember, that's because we took the cost minus salvage value. We divide it now by the 100,000 miles that we anticipate we will use this truck before we get rid of it. Again, all of this information is going to be given you in a problem. Here's the 100,000 miles up here, but also in a business. They'll make these estimates in the accounting department. This comes out to 40 cents a mile, and we've been told that in this year that we're calculating, it's 21,000 miles of use. So we take 21,000 miles times 40 cents. I should have put 0.40. That equals to 8,400. So our depreciation expense for this year would be 8,400. Finally, as a reminder, you debit depreciation expense, you credit accumulated depreciation, and accumulated depreciation is a contra asset. I hope this helps, and there's several problems in textbooks. You can also Google and find YouTube videos about this. Let me know if you have questions.